Hey, it's Charlie from Taxpayer, one of the first sites that allows you to find and assess local tax relief professionals. In our latest interview, we'll be taking a deep dive into the tax world's version of deal or no deal. That's right, we'll be talking about the offer in compromise and how you can make an offer to the IRS. Don't worry, you don't have to wear a flashy suit or stand next to Howie Mandel, but you'll have to pay attention because we are interviewing former IRS Appeals Settlement Officer Peter Salinger, one of the nation's experts with the IRS Offer In Compromise program. Before going into private practice, he worked at the IRS for 30 years and worked over 2,000 offers in compromise. He also wrote and developed seminars. So let's get started. Thank you, Peter. Can you talk about your background?
Okay, well, first of all, thanks for having me. I started with the IRS way back when in 1986. I started out as a revenue officer. I spent a couple of years as a revenue officer, became a revenue officer group manager, probably early 90s. Did that for a couple of years, and I received a temporary promotion in 1998 or so as a branch chief. You all can probably equate that to today's territory manager. Yeah. At that point, I had 5 first-line managers and about 75 revenue offices. Tangled into that was back then the Offer In Compromise program had changed some, so the amount of office that came into the system really exploded. In Manhattan, where I was assigned, we had 2 Offer In Compromise groups, and because of my prior offer experience, they put me to oversee both those groups and oversee the 2 managers. And actually, prior to my branch chief, I should mention I was the Offer In Compromise group manager for Manhattan District. I spent about a year and a half in that position. Late 2000, my wife had an opportunity to relocate down to the Tampa, Florida area, and it was then my job to find a job in Florida. So I eventually was able to land an appeals settlement officer position, and that was in 2001, and that's where I spent the rest of my career until I retired in 2020. I worked all the different cases that come to appeals to a settlement officer, collection due process, collection appeal cases, trust fund recovery penalties, penalty appeal cases, and as well as Offer In Compromise. Because of my Offer In Compromise background when I was with compliance, I became the go-to person in the Tampa office for the Offer In Compromise rejections.
What was the reason Offer In Compromises became more popular later?
The submitting of the offers became easier. They were loosening the criteria. Back when I was a revenue officer, Manhattan, at least I can speak for, the New York City area, they had one person that worked an Offer In Compromise, and it literally came down to, we flipped a coin, heads I'll accept it, tails I'll reject it. And back in those days, very few offers were accepted. It wasn't until they loosened up restrictions and actually did more to develop the Offer In Compromise program. That all became part of, I believe it was the Fresh Start Initiative.
Yep.
And offers just came flooding in like crazy.
What's the craziest Offer In Compromise case you worked?
When I was a group revenue Offer In Compromise group manager, we had an Offer In Compromise where the taxpayer was actually becoming a pain in the butt. So that necessitated my involvement. And unfortunately for taxpayers, whenever the manager got involved in the case, I would remember facts. So, I would make sure you give the taxpayer deadlines and we'd come to agreement on certain things. But anyway, we were able to work it down to where we got this Offer In Compromise recommended for acceptance. And taxpayer, of course, was happy. About 2 or 3 months later, the taxpayer calls and says, I have a federal tax lien. I need to get the lien released. I said, well, I understand that, but until the terms of the offer are satisfied, the lien doesn't get released. He goes, you don't understand. I'm selling a piece of property and I need to get the lien released. So bells kind of went off in my head because I remembered this taxpayer did not own any property, or at least had no property in his name. So it turned out he actually inherited property from his late mother, him and I think 2 or 3 siblings. So of course the tax lien was out there, and he needs to get the lien released so they can pass clear title. Now, taxpayer knew about this piece of property during the offer process. There's a question on the 433A, or do you have anything that you may be inheriting somewhere in the future? And he said no. So it then got to the point where I had taxpayer lied on the 433A. So I had to do some manual research, and we were actually able to rescind the offer in compromise based on the taxpayer's lying on his 433A.
Wow.
So the offer he had was no longer. We got district counsel involved, and we saw that we had the ability to rescind the offer. Of course, he went even crazier, the taxpayer, but no, he lied. We did a referral on the 433A to CID because of the penalties of perjury thing, but that's not even something they would even look at trying to prosecute. So, but it was enough just to get that offer rescinded.
Can you explain to viewers what an offer in compromise doubt as to collectability is?
Okay, well, what an offer in compromise is basically you're saying to the government, I owe the money, but I don't have an ability to fully pay the tax liability either now through full payment or through the life of the collection statute. Here's my income, here's my expenses, here's my assets. Would you be willing to accept an amount lesser than full payment?
Can you talk about an offer in compromise with regards to doubt as to liability?
Doubt as to liability is when the taxpayer doesn't agree with the tax that's been assessed. Now, the interesting thing about a doubt as to liability offer, at least under income tax, if it's investigated and it's determined that there is doubt to liability, the IRS actually does not accept the offer. What they do is they abate the tax. There's also doubt as to liability with a trust fund recovery penalty. So that will be worked by a settlement officer, possibly an appeals officer as well, who would have expertise with the trust fund penalties. Didn't see a lot of doubt as to liability offer in compromises throughout my career. That they don't happen very often. There are times where a taxpayer will submit an offer, doubt as to liability, doubt as to collectability. They'll check both boxes. The doubt as to liability offer always gets reviewed first, because if they make an adjustment, then there's really no reason to look at collectability.
What about effective administration?
Under effective tax administration, the taxpayer agrees with the tax liability. They indicate that they have sufficient assets that will fully pay the tax liability, but in doing so could cause them a hardship or would be unfair or unequitable for the service to proceed to do so. Now, also going back to doubt as to collectability offer, there's also what's called doubt as to collectability with special circumstances. That offer is similar to a effective tax administration offer, but under doubt as to collectability special circumstances, the taxpayer doesn't have sufficient assets to fully pay the tax liability. What they're saying there is that if you ask them to pay the full reasonable collection potential, that could cause the taxpayer some type of a hardship. And I guess the best example there would be, which is actually live examples, taxpayer has a 401k, and say the reasonable collection potential on that 401k is $100,000. Taxpayer look at their financial, there's a negative each month. Taxpayer says they're pulling money out of the retirement account each month to live on. So assuming they can provide all that documentation, what I would do would be is say they're $1,000 a month in the hole that they need to pull from the retirement account. So that's $12,000 a year. If I take that out over a 4-year period, that's $48,000. So I would be thinking about maybe reducing that $100,000 asset by $48,000.
What is the biggest misconception about the offer and compromise process?
The biggest misconception is that taxpayers and representatives alike think the IRS looks at a percentage of the tax liability. So in other words, I owe $100,000. I'll give you 30% of the tax liability and accept my compromise. And it's all based on an income and expense calculation. Over my career, I've accepted maybe 5 cents in the dollar. I've collected 85, 90 cents in the dollar. It all comes down to the taxpayer's particular situation and basically what the figures show. So, you may have $1 million liability that I collect 5 cents in the dollar on. You may have a $50,000 liability that I got 80 cents in the dollar on. The next biggest misconception, I believe, at least my opinion, is that the service must accept my offer. Well, the service has the right to review it. The service has the right to accept it, or they have a right to reject it. So it's not a guaranteed right to have your offer in compromise accepted.
What are initial compliance requirements for an offer in compromise?
Need to be in compliance with filing and payment requirements. So if you need to make estimates, you need to make your estimated. If you're missing returns, the returns need to get filed.
Regarding filing and payment compliance after the offer is accepted, it is 5 years, correct?
5 years, right.
When you have an SFR, which for viewers who don't know, it is when the IRS files a tax return for you, usually not to your benefit because you failed to file. You can validate this if you're not sure about your account by requesting account transcripts, calling a tax professional, or calling the IRS, among other options. Anyway, Peter, an SFR counts in terms of filing compliance for the offer in compromise.
Whether or not you decide to refute it by filing an original return, that's your choice. Sometimes it just costs the taxpayer way too much to get a return prepared. They just accept the assessment. But if it's an SFR assessment, that doesn't affect the offer in compromise investigation. That doesn't make the offer examiner think, well, yeah, this guy's a non-filer, so we got to do SFRs. Why should we accept his offer? That at least should not be the mindset of the offer examiner.
When is the offer considered accepted by the IRS?
The offer is not considered accepted until it's signed off by management, and it's actually, the acceptance letter is actually date stamped. The taxpayer will get a letter showing the offer with a copy of the offer showing the terms of the offer, and then they need to follow the terms of the offer in order to satisfy it. Once the terms are satisfied, if there's a tax lien out there, usually within 30 to 45 days, that tax lien will get released. Sometimes it's a little longer. It's the system sometimes. It just depends how backed up the service is in doing things.
Let's discuss the collection information statement, which is how the IRS assesses a taxpayer's financial situation and collection potential. We have the 433A OIC, the 433B OIC, and Form 656.
Okay, well, there's the 433A OIC, and then there's the 433B OIC. Basically, taxpayers putting in the life history there, where they work, where they bank, what the assets are. Same thing with the B. The B, as opposed to filling out the last page of the income and expense items, they'll usually attach a profit and loss statement. And those are the two things that basically start the offer and compromise process going.
So we need the Form 433A OIC for individuals and the B for businesses, along with Form 656.
Correct.
In calculating the offer the taxpayer should make, we first look at the monthly income against allowable expenses for various expense categories to determine disposable income, and then at net equity and assets, which for real property is generally calculated at 80% quick sale value, correct?
Right. Well, first, income and expenses, that's a pretty simple calculation. Service has certain standards which they go by, and they'll usually enforce them on the expense side on the offer and compromise. There are times where you may end up giving more, but that's really a basic calculation. On the asset side, like you said, it's 80%, but that's a starting number. If you have say real property, if there's a lot of work that needs to be done on the property, or there's a question maybe on title, there's something, you don't have to use that 80%. You can reduce it to 60%, 70%, as long as you can justify what you're deduction you're taking on the property to satisfy reviews of management. There are a lot of offers that I accepted over the years where I actually reduced the value of real property, and that enabled me to get into an acceptable offer range with the taxpayer. And if the taxpayer needs a roof, that needs to be factored in. If the taxpayer needs a new air conditioning, new windows, things of that nature, anything that would bring down the value of that property, you can also lower that quick sale value to get that asset down. So it's 80%, but it's not cut in stone. It's 80%. So, same thing with the vehicle. I mean, you have a car with 250,000 miles on it. Is it fair to take an 80% value of what the value of the car is? Probably not. You have a car with, say, 250,000 miles on it that you said is worth $2,000. 80% of that is $1,600. Is that car quick sale value really worth $1,600? That car's probably worth more as parts than it is to anyone else. So you may want to take 50 or 60% value of that vehicle. You may even want to exclude it. You just may want to say it's worthless. And those little things I talk about, that's where negotiation comes in. If compliance projected an offer and say, I'm looking at the appeal, the taxpayer offered $50,000, compliance came up with $150,000. Unless there's really something major that happened, we're probably not going to get to an acceptable offer in appeals. But if the taxpayer offered 50 and say the collection potential compliance came up with 70, I can get that offer probably down to 60 in adjusting some assets, and I can probably get that taxpayer to raise it 10,000, and we can get to 60. So that to me has been the lost start with the Offer In Compromise program over the years. It's this is my number. You don't like it, appeal.
So in calculating a cash offer or lump sum, which is paid in 5 months versus a deferred payment offer that is paid over 24 months, can you go into this calculation?
So the net monthly difference, if you're doing a cash offer, which is within 5 months, you multiply that by 12 months. So if it's $1,000, it would be $12,000. If you're looking for a deferred payment offer, you would multiply by 24 months. So it would be 1,000 times 24. So basically it's 24,000. So you take that number, then you take the equity and assets. So say it's a deferred offer, so you get 24,000. Equity and assets is 76,000. That's $100,000 offer.
Let's talk about the Offer In Compromise application fee and then payments associated with cash offer and deferred payment options.
It was $205. I don't remember if it was going up for 2023 or not, but it was $205. And then if you're doing a cash offer, you're doing a 20% down payment. If you're doing a deferred offer, you're making the first monthly payment. Now, those payments are not refundable if the offer is rejected or if it's returned for a compliance issue. So you stand the chance of losing the money for those.
And it is usually good practice to send separate checks for the application fee and offer, right?
It should always be separate checks. A separate check for the user fee and then a separate check for the down payment. Just makes processing easier for the IRS part of it. And also it's easier to locate on a transcript if you need to pull a transcript to find out what the status of an offer is or to make sure the offer was received even.
In terms of 401ks, they are generally valued at 70%, correct? But they can be valued at 80%.
Right. That's usually reduced 30% to account for the 10% penalty in taxes. So if the taxpayer is over 59.5, you may want to look to adjust that 30% down to 20% because they're not paying that 10% penalty.
Regarding bank accounts, there is an exclusion too. Can you explain?
It's $1,000 or 1 month's expenses they look at also. But they don't do that for business taxpayers. That's only for individuals. Yeah, and I recently had a case where the taxpayer has been drawing funds down from the bank because they've had a large loss of income, and that reduced basically the equity and assets for an Offer In Compromise.
What happens if the offer in compromise is rejected by the IRS? How long does the taxpayer have to appeal?
Okay, the taxpayer will get a rejection letter giving them 30 days to appeal that rejection. Now, it's an administrative appeal only, so you don't have any court rights on that offer rejection. If the appeal that you're sending is postmarked or received on the 31st day, that is not you. There's no extension of the 30-day limit. It's 30 days and that's it. So if you get one that says 31 days, that appeals will send back the offer saying that they blew their appeal rights. So there's no way to resurrect that once you miss that 30 days. The only way would be just to submit a new offer for consideration.
So explain briefly the appeals process in terms of when you would enter the equation.
Basically, the taxpayer or the representative sends in the items that they disagree with. The offer examiner is supposed to be reviewing that information and possibly make changes onto their income and asset tables. 99% of the time, they just put it in an envelope and mail the case out. They don't even look. But in appeals, my initial analysis of the case would be to review the documents or review the information that was provided and see what the taxpayer disagreed with. And then based on that, if I didn't have enough information based on what they disagree with, I would give them an opportunity to provide me with that additional documentation.
How much time is it taking now, considering the pandemic backlog, for an offer in compromise decision?
At the district office level or COIC level, those offices prior to COVID were running probably 9 to 12 months. Now the office are probably running a little bit longer than that, maybe 10, 12, 14, 15 months before they actually make a determination.
But they have to give you a decision at least by 24 months, correct?
Basically, the service has 24 months from the date of submission of the offer to make a determination to reject or accept. If they don't, on 2 years and 1 day, that offer is deemed accepted.
Wow.
But like I tell people all the time, that the biggest no-no in working for the government, working for the IRS, is blowing a statute. Whether it's a temper statute, an exam statute, or a collection statute. Back in my day, you earned yourself at least a 1-day suspension if you did that.
How can a taxpayer prepare for the offer in compromise process? There are booklets the IRS provides, right? And why use a professional such as yourself?
There's a booklet for the Form 656. It's actually one of the better forms. Back in the 90s, the offer in compromise paperwork was just horrid. And they eventually put a team together that fixed it up. And if you follow the 433A OIC through, you should be able to figure things out. A lot of taxpayers do offers pro se. There's no higher acceptance or rejection rate on a pro se taxpayer than there is if a taxpayer uses a representative. I would always recommend using someone to do an offer in compromise, because a lot of things that you as a taxpayer may not understand or figure out is something that I as a representative can figure out. On the initial submission of the offer, it's really important to have professional help there, because while the forms may be easy to fill out, that doesn't mean you're going to have a full understanding of what you should be putting down and what the process is.
What are some expenses that can help lower a taxpayer's disposable income, or that taxpayers are afraid to incur because the IRS may not allow it?
I reviewed the 433A. The taxpayer has a car that's paid for that has 150,000 miles and looks like always needs a lot of work. So my first question to the taxpayer is, have you ever thought about buying a new car? Well, I'm afraid to, because I don't think the IRS will allow me to do that if I owe them taxes. Well, the IRS will allow you to purchase a car as long as it's within the guidelines. So as long as your payment was within reason, that's an allowable expense. So individuals think that they can't do certain things because they owe the IRS money, and it's our job as representatives to assure them that they can do certain things. Yeah, the other thing too is health insurance. I mean, if you need health insurance, go out and buy health insurance.
I see.
That's an allowable expense. You know, life insurance is an allowable expense. Just don't get it if you're making 50,000. Don't get a $10 million policy because they're not going to allow that whole thing. But
Right.
you're allowed certain living expense. The IRS isn't trying to rip everything away from you. They're not saying cancel your health insurance. Give back your car, things like that. As long as you're living within the standards that the service provides, you should be fine.
What are some alternatives to an offer in compromise that the taxpayer should consider?
Okay. Well, first of all, to me, offer in compromise is the last choice. When a client comes to me, when I review financial information, I almost take the IRS mentality. First thing is, can they full pay? Do they have assets to fully pay? If not, is an installment agreement the right thing to do? Is it a full pay installment agreement? Is it a partial pay installment agreement? Are they currently not collectible? So those are the things you have to look at first before you get to the offer and compromise piece. And a lot of these places out there today, they advertise pennies on the dollar. And while it may be pennies on the dollar, it just depends on your financial circumstances. If you have $2,000 a month left over and you owe $25,000, $30,000, the IRS is going to take you a $100 offer. So there's a lot of misconceptions out there that the offer should be the first thing you go to, whereas it's not your first choice. It shouldn't be. And if someone says to you, oh, you're a perfect offer candidate, and they haven't even reviewed your financial information, you need to find someone else to represent you.
How can you help taxpayers now that you're on the opposite side?
I don't claim to do anything magical. They're not going to accept an offer because, hey, I know that guy, Peter. He used to work there. It's probably a good offer. I just do the groundwork up front. I'll sit down, do the financial statement. I'll go through it. I'll go through the assets. I'll basically do an offer investigation before submitting an offer to let the taxpayer know this is what I've come up with and this is what your options are. And yeah, you may be a good candidate for an offer.
What if you submit your offer and then later lose your job?
The IRS is still going to look at that as monthly income. Or say, you used to making $150,000 a year, your income is now cut in half. The IRS wants to see a track record of that lower income. So say over a 12 to 18 month period to show that reduced income piece. At that point, they would actually take the lower figure because you're unemployed today. You may have a job in 2 weeks. So just because you're not working or your income's been reduced and it's been like that for the last 30 days, that doesn't necessarily mean it's going to stay that way. But then the other factor you look at too is the taxpayer 34 years old? Is the taxpayer 74 years old? And you're going to look at those taxpayers a little bit differently because of their age and their ability to keep working.
During your career, did you see some of these offer and compromise mill companies or national firms?
Absolutely. And what would happen then is, they would either not respond to my request in appeals for a conference or information. They would just normally ignore me. But there was one mill, their favorite offer was $150. And eventually I'd end up having to speak to the taxpayer because the taxpayer wasn't able to pay the mill anymore, so they stopped representing them. And then I'd find out that the service that they paid this mill $15,000 to submit and do the offer submission. And I said to him, I said, does it make sense for them to give them $15,000 to offer 150? And you can do better than that? Well, they said they can get me pennies on the dollar. They can guarantee it. And I said, once they say they can guarantee something for you, it's really time to hang up the phone and walk out the door because nothing is guaranteed except maybe a guaranteed installment agreement. But in terms of offer and compromise, nothing is ever guaranteed. Still has to be investigated and a determination has to be made.
I know state attorney generals would go after some of these companies in the past. Would the IRS take some action against some of these companies sometimes?
There was actually one company down in the Carolinas that the IRS was able to get shut down back in the early 2000s. And then there was one in California. I think they were able to get that person to stop representing taxpayers, but I think that person is actually back representing taxpayers.
Thank you so much, Peter. You've provided so much information, not only for taxpayers, but hopefully for some tax professionals. At Taxpayer, we help taxpayers search and find tax professionals in their area that have knowledge and experience resolving specific state and IRS tax problems. Unfortunately, many of these national firms with high-powered sales reps take advantage of taxpayers in many cases. We are on a mission to provide much-needed transparency in the industry. It is bad enough when taxpayers are in a distressed situation. They don't need companies to take advantage of them.
Right, and they take advantage of it because they know the situation they're in and they're desperate to do anything.
I appreciate your time, Peter. Thank you again.